Most traders can't get funded. If you don't believe me, prop firms have admitted that over 95% of their revenue comes from failed challenges. This isn't random. The game was designed for you to fail. Prop firms want you to gamble, to trade without an edge, to not know how to use risk management because they know that eventually you will blow up. But that changes today. Today, I'm going to share with you the blueprint to get funded this year. We are going to cover everything from strategy to risk management to how approach prop firms in a conservative way, which will almost guarantee that you will pass, or in an aggressive way in which you are going to play the game of prop firms, but you will play it in your favor. There's so much information on how to get funded out there on YouTube, but no one gives you a strategy, a full video with everything. This video is going to include market structure, daily bias, market maker models, absolutely everything you need in order to become profitable as a trader so you can get funded. This is information that other people charge for, yet I'm giving to you all for free and all here in one single video in less than 2 hours. So pay close attention, take notes, because I'm going to show you how to get funded this year. Let's go to the charts. So we're in the computer. Let's talk about the full guide to get funded in 2025. I made this whole thing. It took me days to put this all together because the idea is I want to give you all a video that will allow you to watch this, apply the concepts that are given here, learn the concepts that are given here, apply it on the charts, and be able to get funded in 2025. That's why I have called this the full guide to get funded in 2025. We are going to go over strategy, we are going to go over risk management, we are going to go over basic and advanced concepts. And I dare you to watch this whole thing because there's a very high chance that something that is mentioned here can be the click in your trading that was missing that will get you to be a profitable trader. So let's go into the strategy. So how to get funded in 2025. Let's start off with the strategy because this is the reality. A lot of people, they want to get funded, but they never want to put the work into getting a profitable strategy, a strategy that is proven. This strategy has got me hundreds of thousands of dollars in profits. And I know that if I want to focus this week on getting funded, I can get a funded account. All because I have a profitable strategy. But a lot of people do it the other way around. They want to get funded, but they don't have a strategy. So let's start off with the foundation. And by the way, I do dare you, for example, right now we're going to talk about market structure. A lot of you probably already understand market structure, but this is the reality. There's going to be things in here that you have never seen before, or maybe you've never thought about before. So I challenge you to watch the whole thing, starting off with market structure. So what is market structure? Market structure is the tide of the market. Just like a river that flows downhill, the market also has its tides. The difference, the market doesn't only have one, it has multiple, and it can change at specific moments. So we can see that right here as the market is moving to the upside. It's forming higher highs and higher lows, right? This low is never getting breached. And so because of that, we define this as being an uptrend. Now, what is the problem? Well, let me ask you as a trader, how do you think it would be better for you to survive in this situation? Let's say we have a river and the river again is flowing downhill, right? So the river is flowing in this direction. Now you are in the river and you want to get out, and you can either have a rock that is up here where you have to swim upwards, or you can let yourself go and there's a rock down here which you can grab on, and this rock is even bigger. Well, the traders that trade against market structure, what they are doing is that they are trying to scramble and, oh my God, I have to swim up towards this rock because this is what I'm seeing. Well, profitable traders, what they do is they understand if they let themselves go with market structure, they will find a good trade. That's why market structure is so important, and understanding market structure is so important. So because this is going to be the tide, the direction in which the market is moving. You've probably seen it sometimes where when the market is moving in a bearish trend, the bearish moves are very, very impulsive, while the bullish moves, they're tiny and they barely move, right? And that is because those moves are against market structure. So understanding market structure is understanding where price is more likely to go. Trading with market structure is always higher probability than trading against market structure. But there's two different market structures. There is internal market structure and external market structure. And that's when we come to a concept that I call the fractality of the market. While the market structure on one specific time frame might be bullish, on another time frame it might be bearish. But the same concepts apply within all of the time frames, meaning understanding market structure is applied in every single concept. Understanding how different time frames can greatly improve our understanding of market structure and increase the probability of the trades that we are taking. Meaning, it's important to understand that for us as traders, and you will see this happening a lot, you'll see that this video, as you go forward, things start piecing together and you'll reach amazing conclusions that maybe you've never thought of before. So for example, let's say that this black line that we've had from before was the 4-hour chart. On the 4-hour chart, we might be bullish, but every time the 4-hour chart is pulling back, if you check the 15-minute, the 15-minute is actually bearish. And this is the problem. A lot of people, they only trade the 15-minute, or they're so focused on the 15-minute that they forget that there comes a point where the market comes to a higher time frame level, like a key support or resistance level, in which the market is very likely to inverse on the 4-hour, right? So the way I put it to my students is we always have daily, 12-hour, 4-hour, 1-hour, 15-minute, and 5-minute, right? You can also add the 1 minute, but the 1 minute is just going to disrespect so many times that it's not really worth it. And you always ask yourself, what is more bearish and what is more bullish? And let's say that the daily is bullish, right? The daily is bullish, the 12-hour is bullish, the 4-hour is bullish, the 1-hour is bearish, and the 15-minute is bearish. There's going to come a point, a higher time frame key level, in which the 15-minute is going to turn bullish. So this is going to turn bullish, and all of a sudden, this is going to be a very high likelihood of the market moving to the upside. So you can see right here that the market moves up. So the 4-hour is bullish, the 15-minute is bullish, everything is bullish. This is a high probability long. And then the market starts pulling back. Once we reach a higher time frame support, this is when you watch out for 15-minute inversions, and then the market goes to the upside, and it's again a very high likelihood of the market playing out. So it's always important to think about the different market structure in different time frames. Now, when does the market shift? A market shift happens when the body of the candle disrespects the last premium and discount array, which is what a PD array is. We're going to talk about them a little bit after. Disrespects the last PD array, acting as a line of defense of market structure. So as you can see right here, as the market is moving lower, the market is on a bearish trend, right? Once we close bullish, the job of this high is to hold price action from moving higher, just like this one did, just like this one did, so on and so forth. But as soon as the market closes above, this high did not do its job, therefore the trend has shifted. The higher the time frame, the higher the probability of the market shift. And we always look for body closures. Wicks do not matter. There's a saying that goes that wicks do the damage, body tells the story. And that means that only if we close with the body above or below do we consider it a market shift. So always keep in mind, the more structures in line, the higher the probability. And so I have this right here, this diagram, which is daily, 12-hour, 4-hour, 1-hour, 15-minute, 5-minute, and daily. These are the time frames that we are going to be trading. And you always ask yourself, is it bullish or is it bearish? And the more time frames in line with the trade that you are taking, the higher the probability of the trade that you are taking. Because again, if you want to take a long, then at least the daily should be in line. The 12-hour, the 4-hour should all be aligned. The 1-hour, 15-minute, and 5-minute don't matter as much. Now, market structure is about direction. And one of the crucial concepts is the daily bias. We need to understand how the daily bias works and what what the daily bias means is that we are going to predict where the next daily candle is going to go. A lot of the mistakes that traders do is that they try to forecast where the market is going to move next. Is Bitcoin going to go to 150K or is Bitcoin going to go to 20K? Is $0 going to move up 10% or move down 10%? Is Nasdaq going to move up 10% or move down 10%? We don't need to know that because that is very, very likely not going to happen in one specific day. Therefore, we only want to forecast what is going to happen tomorrow. Obviously, we like to have a sense of direction in the market, and market structure tells us a lot, but it's important to understand the direction of the market. Now, what is it? Daily bias is our forecast on what the next day's price action direction is going to be. If the daily bias is bullish, we expect today to move bullish. If the daily bias is bearish, we expect today to move bearish. It's a very crucial concept that if mastered, it's going to pay huge dividends. Now, one of the things you will understand is that market structure and daily bias, they apply super similarly. So we have the market moving up, right? So this is bullish market structure. The market moves lower and now it's forming this bullish order flow. So your daily bias is going to be bullish up towards this high, and then the market continues moving bullish. Your daily bias remains bullish until when? Now we have the market shift, and your daily bias remains bearish until when? Until you're proven otherwise, the market moves bullish, and then we have this failure and the market moves lower. Notice we have a fair value gap right here, which is going to be a PD array that we are going to be talking about. We have this very nice daily closure. So if I ask you right now, where is the daily bias going to move tomorrow? The answer would be bearish, and you would ask yourself, where is the market going to go? And there you go, that's the low that you would target. And that's exactly where we went to. Now, the answer to what is the daily bias comes from two different questions. And those questions are, where are we and where will we go next? So when we ask, where are we? Is the market structure bullish or bearish on the daily and on the 12-hour? Where will we go next? Following that market structure that we've just defined before, what is the next liquidity that we are targeting, internal or external? I've just introduced the concept of liquidity, which is exactly the next one that we are going to talk about. So here are some examples of the daily bias. So what would be your forecast right here? You can see that the market is moving to the upside. So you can see the market moving to the upside right here. We have market shift. The market moves lower, so second market shift, and the market moves lower, starts reacting bearish. So what do you expect the market to hit? Well, we have internal range liquidity and external range liquidity, and those are the ones that we target. Or afterwards, so this is on the next day, what would your daily bias be on the next day? Would it be bullish? Because the problem is that so many traders look at this sort of price action and they start thinking, no, the market is bullish now. The market is bullish now. They don't see exactly what is in front of them. So when we see this, we have internal range liquidity, and external range liquidity. This is the swing low of the market structure, right? The market moved lower, followed by this move to the upside. So this is external range liquidity. We're going to talk about liquidity right after. So these are going to be our targets: internal range liquidity, internal range liquidity. And those were basically the one that we targeted. We targeted the first internal range liquidity, and we basically came towards the next internal range liquidity. Funnily enough, if we would have taken a trade here, we would have taken advantage of the whole move because, again, we'll talk about it in the trade management section. So make sure to stick around. Now, the next one is right here. What do we have? We have the market moving up, followed by bearish. Now, let's think about this. What have we just talked about before in market structure? What is the market structure right now? We have high, low, high. But internally, we are bearish, right? You can see that internally we are bearish until now that we've switched market structure back to bullish. So your next target would be the internal range liquidity and internal range liquidity. Again, this is going to be external range liquidity. So your next target for tomorrow, because again, you don't need to know if we are going to go towards this high or this low, unless you're swing trading, meaning you're holding trades for days and days and days and days. You don't need to know if we're going to all-time highs or if we are going towards these lows. The only thing you need to know is where are we going tomorrow. And as you can see, the market eventually reached this internal range liquidity, and then on the next day, it reached the next internal range liquidity, which then eventually, by the way, it did go to the other highs. So you can see how the daily bias is pretty simple. You don't need to overcomplicate daily bias. It's think about market structure. Think about the market structure internally and externally. And then you ask yourself the questions: where are we? And where will we go next? Is the market structure bullish or bearish on the daily and 12-hour? And then where will we go next? Following that market structure, what is the next liquidity that we are targeting? Internal or external liquidity? So we now have both market structure and daily bias, which are going to be extremely important in our trading because it tells us the direction of the market. Nothing is more powerful than understanding the direction of the market. And I want to introduce a concept that isn't even here, which is a profitable trader is simply a trader that is able to execute in line with the correct direction, right? Because an execution or a trade is just direction and execution, right? So your number one goal is to master the direction and then you master the execution, not the other way around. And by the way, if you want this resource fully for free, check the link in the description. The resource is going to be there. Okay, so now on the daily bias, we introduced the concept of liquidity, internal range liquidity and external range liquidity, right? So now let's talk about liquidity. And with liquidity, we have two types of liquidity. We have structural liquidity, which is based on market structure, and we have time-based liquidity. Time-based liquidity, we'll dive into this very soon, but let's first talk about structural liquidity. Because what is it? Liquidity is resting orders. The market is efficient and it's moved by supply and demand. For every buyer, there needs to be a seller, and for every seller, there needs to be a buyer. Meaning, once again, that is liquidity. That is how liquid the market is. Liquidity in the charts is simply seen as highs and lows, but it's the magnets of the markets. Liquidity is what draws price, just like a magnet. So you can see right here, I have this example of two external range liquidities. We have liquidity at the bottom, liquidity at the top. You can see that the market moved up. And by the way, notice we have bullish market structure. So the market comes to a area of support and then moves to the upside, right? We tapped that liquidity and then notice what we did right there. We actually have a market shift. You can see it right there, market structure shift. And then we move to the downside, creating bearish market structure and then moving to the low. So you can already see how all of these things start piecing together. But what's important to understand with liquidity is that all of the highs and all of the lows, they are liquidity. So for example, on this move to the upside, you have the external range liquidity, which is going to be the external of the market structure. And all of these small highs that the market did, those are all resting orders that are still there. And that is what liquidity is. And that is the draw of the market. Because again, the stock market or any sort of financial market, it is an efficient market. And therefore, liquidity tells us where price is likely to go. So liquidity can be divided into two, and it is external range liquidity and internal range liquidity, right? So external range liquidity is, as we talked about in the bullish market structure and bearish market structure, it's basically the highs and the lows of the external market structure. That is what the external range liquidity is going to be. And then internal range liquidity is on the other time frames. All of these highs and lows that are being formed, those are going to be the internal range liquidity. And those are going to be very crucial when it comes to our management. And I will explain to you why very soon. Which is the external range liquidity is the overall draw of the market. It takes more time to pan out, right? Because we're talking about market structure. We're talking about areas that are harder to get to. While internal range liquidity, they are the easy draws of the market. It's where the market is going just to make price efficient, right? The market is constantly going there. The market is always taking out internal range liquidity. So That's where I introduced the concept of the extreme. And this is going to be very, very important because a lot of people don't understand that this is one of the big things that makes them unprofitable. So I hope you are still paying attention. So the extreme is the one last point of reaction. It's basically the last point of liquidity, of internal range liquidity before the external range liquidity, right? So this is usually where we have our reactions. And that's one of the reasons why so many traders take so many break evens, is because they're constantly trying to aim for the external range liquidity. While you now understand that external range liquidity is the overall draw of the market, but it takes more time to pan out. And while it takes time to pan out, the market might completely reverse and take you out for a break even or even a loss. Therefore, you want to target in a trade, you want to target the easy draws of the market. And that is why this is where most of our profit taking is going to take place. It's going to be at the extreme because you're basically taking the most amount of risk to reward possible, but you're not targeting the external range liquidity that is going to take just a little bit more time to play out. So now we have market structure, which is the tide at which the market is moving, the direction in which the market is moving. Then we have the daily bias. Daily bias is going to help us forecast where tomorrow or today is going to move. And then we have liquidity. Liquidity is what we are going to use in terms of magnets of price. Therefore, they're going to help us with the daily bias and even with the market structure. So now let's move on to the next fundamental concept, which is the power of three. The power of three is what has always been in front of us, yet we've never seen it until we think about it. Just like time or even our noses. You don't think about your noses, yet it's right in front of you. You don't think about time, yet it's always passing. The power of three is the way the market moves and the way the market delivers price. And let me prove that to you. So you can see, I took this screenshot just randomly from the chart. You can see that most of these candles, they have two things. And this one, I even went to Google and I typed bullish and bearish candle. And this is exactly what came up, right? A bullish and a bearish candle. The only thing that changes is the color. But notice one thing. What do both of these candles have in common? They have two wicks and one body. What that means, what a candle is, what a candlestick is simply a depiction of time and price. So a candle just shows you at the time of open, this was the exact price at which the market was. At the candle close, this is exactly what the price was, and that is going to form the body. And then the high and the low are going to be the highest price and the lowest price in that specific time period. But what we fail to understand is that that already shows us so many things about price that we can apply, which as look at how price could deliver. Let's imagine that this is a daily candle where you would expect the market to range a little bit, the market to manipulate. So that's where the low is going to form. And then you have the expansion towards your target. And then we have a little bit of a reaction after the target. But what I'm trying to say here is that one candle tells you a big story. One daily candle can tell you a lot of where the market is going, of where the market has gone, of where the market is heading, right? So that's why it's important to understand that the power of three is going to be an extremely incredible resource to have in your arsenal. And this is the power of three in action. We have the daily open. This is on a day that I had a bearish bias. We have the move to the upside, right? So this is all what we are going to call manipulation, which we are going to talk about very, very soon. This is called the manipulation. Then the market moves to the downside, gives us the market shift. I enter, and then the market moves to the downside. This was actually a trade that I personally took. And then we also have that in London session. Now, and I will explain exactly what the power of three means in the market, how we can think about the power of three. Now, what is it? The power of three is divided into three parts: accumulation, manipulation, and distribution, which some people also call AMD. Once you see it, you can't unsee it. The power of three is boiled down to the way that the market moves by creating a range, manipulating, and then expanding. And at some point, a bullish daily candle was a bearish candle, and a bearish daily candle was a bullish daily candle. And the highest probability trades will happen at the top or at the bottom portion of the power of three. So we can see right here a bullish daily candle, right? So we have a bullish daily candle right there. We have the range, we have the manipulation, we have the market moving to the upside and then closing a little bit lower. Same thing on the bearish, we have the range, we have the manipulation, followed by this move to the downside. And notice what this manipulation did. It took out this liquidity. And then it came towards all of this liquidity right here at the bottom, right? So the power of three is everywhere. It's on the weekly, it's on the daily, it's on the 4 hour. I can tell you all of the single time frames that we trade, but it's also in a session and it's in any single candle. If we're talking about the 1 minute, you've probably already seen a candle that starts extremely bearish and then finishes extremely bullish. That is simply the power of three. Now I'll tell you right now what that means. But before that, the power of three allows us to add one more question to the daily bias for more precision. Where are we? Where will we go first? Which means the manipulation, meaning again, where are we going to manipulate to? Right there on this manipulation, what do we expect the higher time frame to go to? For example, we would expect to go to an order block or to a fair value gap. And then where will we go after? This is going to be our daily bias. Personally, I don't really like to add the second question. I only do that once the session starts, right? Now, what is the power of three itself? The power of three, it shows you everyone that is making money and everyone that is losing money. So that's the way that we are going to frame it. The power of three simply shows us that if the market opened, let's say that the market opened and it just moved bullish, that means that every single person that longed is making money. And we know that in the financial markets, most people get manipulated, right? That's why we see very big moves lower before the market has an extreme rally. That's all the power of three. That is all the market playing on people's emotions to get out of their trades, be liquidity for the institutions to the smart money for then the market to move, right? So if we understand the power of three, we understand who is making money and who is losing money. And that is probably one of the most important concepts that you can know. Because let's say that your daily bias is bullish, right? For example, just like right here, your daily bias is bullish. And now you see the market moving to the downside. A lot of traders, what they would do is that, oh my God, maybe I'm wrong, I have to go bearish. When in reality, this is all the market generating liquidity to then give you the actual push. So every time that I am bullish or bearish and the market moves in the opposite direction of my daily bias, that just increases my confidence that if afterwards we have a market shift, I will be very interested in longing, right? Because the market has now manipulated everyone. Bulls have now turned into bears. Everyone is shorting because they think that this is a breakout and all of them are just being generated as liquidity for the market to give us the actual push. So that's why I really like to use the power of three in my analysis. I use that in sessions, I use that in candles, I use it for entries, I use it for exits, I use it for everything because it just tells me who is making money and who is losing money, right? There was one point where the market was very bearish, and that is why people start entering in shorts when in reality the market is indeed bullish. So the power of three is the answer to the question, who is making money and who is losing money? And just understand that not everyone is going to make money in the markets. It is a zero-sum game. Therefore, we need to focus on the power of three every single time, especially for manipulation. And now that we have talked about market structure, daily bias, liquidity, and power of three, let's talk about PD arrays, because you've heard me say fair value gap, you've heard me say order block. Right now, let's talk about what those actually are. So fair value gaps, what is it? Fair value gaps are a 3-bar pattern that give us a lot of information about where the market is moving and where the market is likely to go. Fair value gaps are a gap in efficiency in the market, literally a gap in fair value. due to quick price delivery. Therefore, markets usually trade into them in order to create efficient price action. This gives us amazing opportunities to read the direction of the market and even execute on trades. So what that means is that a fair value gap is created when we have very quick price delivery. As I've said before, the market is efficient, or the market aims to be as efficient as possible, which means give everyone time to trade, right? So when we have these big pushes in the market, we're creating gaps, and we can see it right here. I have a depiction of fair value gaps. It's a three-part pattern, right? And the third candle basically defines if we're going to have a fair value gap or not. Because if the market would have come all the way down here and these two wicks would have met, then we would not have a fair value gap. But as you can see, there is a gap between the first candle high and the third candle low. The same thing on a bearish fair value gap. There is a gap between the low of the first candle and the high of the third candle. That gap is the fair value gap. So there are four main fair value gaps. What do they look like? There are many different names that traders give to different types of fair value gaps, but the main ones are the fair value gap. So we've seen this. We have the balanced price range, or BPR, where the market moves up, moves back down, and then it creates two fair value gaps that overlap. That is what a balanced price range is, and obviously this has to be at a key level. And then we have the breakaway gap. This breakaway gap, the reason why I have it here is because this breakaway gap is a gap that should not be traded into, and they are defined by the third candle in the market. Because if the third candle is very impulsive, you don't expect price to move all the way down, because that would show that there's a loss in momentum. So on a breakaway gap, you don't expect the fair value gap to be tapped into. And last but not least, we have the inverted fair value gap, which is a bullish fair value gap that gets a market shift, meaning a body candle closure below for the market to tap into it and then move lower, right? So an inverted fair value gap is simply a bullish fair value gap that was completely disrespected, or a bearish fair value gap that got also disrespected. Usually these are very good levels to trade from towards the opposite direction. Now, one of the cautions is that all of these fair value gaps are absolutely worthless if they are not traded at a high value area. So a lot of traders, they look at this and they're like, oh, okay, now I understand what a fair value gap is, so I'm going to trade. And they go to the 1 minute and they look for a fair value gap. What they don't understand is that fair value gaps do not matter if they are not in a high value area, which means all of these concepts, they need to be paired with more advanced concepts that we are going to talk about very soon. But that is what a fair value gap is. Now, levels to look out for on a fair value gap. It's the open, the consequent encroachment, or the 50%, and the close. You can see it right here. We have the open, the 50%, and the close. So open of the fair value gap, this is going to give you the reactions. The 50%, again, you also expect this to give you a reaction. And the close, the reason why the close is important is because if you close below the close, then all of a sudden that fair value gap has been disrespected. And the same thing on the bearish, we have the open, the 50%, and the close. Now, you can see it right here where the market reaches a key level right here, and then the market starts moving higher, right? So we have this bearish fair value gap that is supposed to hold. So notice how we are going to have so many things already on here. So we have liquidity that gets swept. We have market structure that is bearish until when? Until we break bullish. But the first signs of it is that this bearish fair value gap that is supposed to hold was inverted. Then it doesn't really come back into it. But once we have the market shift, very quick price delivery, fair value gap, market taps into, moves higher. Fair value gap, market taps into it, moves higher. Fair value gap, the market taps into it, and it moves higher. So you can already see fair value gaps in play right here. So that is what a fair value gap looks like. That is what a fair value gap is. Now, order blocks, what are they? As the name suggests, an order block is a block of orders. These are specific areas where large trades have been placed by smart money. These levels are expected to be respected because smart money will want to protect their positions. So The way that smart money and us trade are very, very different. If you want to put on a $1 billion position, you can't just press market order. The market is you're going to be absolutely destroyed if you do that. So they have to generate liquidity. And that is what the block of orders is going to show us. So we have the generation of liquidity followed by the large injection of liquidity that creates what we call the order block, because a lot of orders were put in these levels and these levels to the upside. Once we have the market shift, this is what we are going to call the order block. So everything that is in blue is what we call the order block. But what do they look like? There are many different names different traders give to different types of order blocks, but to simplify, we can boil it down to two. And there are going to be breaker blocks, which are going to be reversals. For example, let's say we are at a key level, because again, caution, all of these order blocks are worthless. Don't think they're worthless if not traded in a high value area. That is extremely, extremely important to understand. This has to always be paired with high value areas. But again, we have the breaker block, which is a reversal block. So we have this that you would expect to happen after we reach a key level. And then we have the continuation block, because once the market continues moving to the upside, what are order blocks showing you? It's showing you that bulls are still in charge. In this case, bulls are still in charge. We're still having these moves to the upside, right? That's why order blocks, fair value gaps, they show you where the market is going. They show you the direction of the market. And that's why order blocks and fair value gaps also show you who is in control of the markets. You can see it right here, right? For example, on this move lower, we have this move higher, followed by this big rejection, right? We create this reversal block. Then we have this big move to the downside. This creates our breaker block, which is the break of market structure. Then we have the tap of the order block, and then we move lower. So all of this already is showing you, look, the bullish candles are always being disrespected by bearish candles directly on the next one. It doesn't have to be on the next one, but directly on the next one, they are already being disrespected. So order blocks, they show you who's in charge. And for example, let's imagine that this is a daily candle, right? Let's imagine now, let's think about market structure, right? Let's think about everything we've talked about so far. So what's the market structure? The market structure is bearish. Then who is in control? What would your daily bias be? Well, where are we? We are bearish in terms of market structure. So my daily bias is going to be bearish. I'm going to look for a level here that I want to target, and then that's going to be my daily bias. And then if we add the power of 3, where will we go first? We will go to the order block, because the market is always moving between bullish and bearish PD arrays, right? The market is always moving between order blocks and fair value gaps. You just need to find the high time frame ones closest to you, and you will be able to understand what the magnet of price is. Now, levels to look out for is the open, the 50%, and the close. So we have open, 50%, and the close, open, 50%, and the close. Once again, why are these important? Because the open, this is where you are expected to have the largest reaction. The 50%, it's also a key level, because after the 50%, smart money would be losing if they've averaged in on the order block. And last but not least, the close, because if we close above it, that means that the market is now bullish, because we have disrespected this bearish order block, or in this case, the bullish order block. Here we see order blocks in action, where we have the market moving to the key level, which is this high right here, followed by this bullish order block this is a continuation block, but it gets disrespected. And then you can see breaker block gets tapped into, then moves lower, move up, followed by the move lower. So this is a continuation block, market taps it, and then it moves to the downside. It also taps it here, and then it moves to the downside. So that is how you can see beautiful order blocks in action. Now, one of the things to remember is that the market is always moving from bullish to bearish PD array. That means that the tide of the market is always from bullish to bearish PD array. These can be highs, these can be lows, which by the way are also bullish and bearish PD arrays. But that's what you can see here in market structure, right? We have bullishness, then the market moves lower. What is it looking for? The market is looking to balance itself out. Again, we've talked about the efficiency of price. Then we have the reaction out of it. So again, the market is targeting this high and then eventually a little bit higher. And then we have the move lower, tapping a bullish PD array and then targeting the bearish PD array, which is going to be this high. Then we have the move lower, then we tap the bullish PD array and move higher, right? Then we have the market shift. And then what is the market doing? It's going to target the bearish PD array, and then we are going to target the bullish PD array, which is going to be this low, so on and so forth. So it's important to remember that the market is always looking to target either bullish or bearish PD arrays. This is very, very important. Do remember that if you want this whole resource for free, the link is going to be in the description. Now let's talk about advanced concepts. We've talked about the PD arrays, we've talked about direction of the market, but I've always said that it's always important to execute in a high value area. But now you might ask yourself, but what is a high value area? And that is what we are going to talk about first. So as mentioned previously, no concept is worth anything if applied in the wrong area. High value areas are the areas in which we will look for our confluences. These are divided into three sections: A, B, and C. So for example, let's say that the market is on a bullish uptrend, right? And then we have a bullish fair value gap on the 4-hour right here. And we know that it is very, very likely that the market is going to tap the fair value gap and move to the upside. So you would ask yourself, where will we go next? What is the next target? And you would have an external liquidity right here, right? So if that is the case, what you are going to do is you're going to draw a Fibonacci and you're going to divide it into 33, 33, 33. This is basically, at first you can do this because it will help you. Afterwards, you will just start to understand how this works. But then you will divide all three into A, B, and C, because the beginning of the move is going to give you the highest probability entries with the most amount of risk to reward. And so this is where you want to execute. Correct? Because afterwards, there's no more range for you to take advantage of. Therefore, it's not worth it to trade in the C area. But this is going to show you very, very well what the high probability and low probability to trade areas are. The same thing is on the move lower, where you have the range. Let's say we have the move towards the high, and then we have the high value areas in which you want to execute, the continuation trades in which you want to execute, and then this move to the downside. This last third you don't want to execute anymore, and I will explain to you why right now. So what does this mean? A area is a high probability of the trade playing out. If the bias is right and the higher time frame levels hold, no manipulations and stop runs are expected. The B, 33% to 66%, good probability of a trade playing out. Continuation trades will allow us to take advantage of the expansion towards the targets. It reduces the risk to reward due to having more conservative stops. What I mean by that is that if you're taking a trade right here and you don't want to get manipulated out, your stop loss will have to be somewhere below the A range. So you're not going to have as big of a risk to reward going to the target, but that's fine because now this has been confirmed. So this is still, the B is still a good probability of playing out. And then the C is the low probability of the trade playing out due to possible deeper reactions that still respect market structure and not enough of a risk to reward to compensate for the lower strike rate. So what I mean is, for example, like we can even see this as an example. As the market tapped this 1-hour order block right here, you can see the market tap the 1-hour order block, and you would expect the market to come to this low. If you divide this into three sections, this is what you would get, right? So this would all be high probability for the market to play out. This would also be good probability of the market playing out. But here, you are already risking these big reactions. And anyone that is entering down here then is taking the loss. Why? Because they don't have a good risk reward here. Therefore, they have to reduce their stop loss. And then if there's any sort of manipulation, they get tagged out of the market. Now, in a little bit more detail, A is the first third of the range. You're going to have the best risk to reward. The risk is still there because we could miss the low. The market could go lower one more time, but it's the highest probability reversals that happen in this area. The reason why it's the A area and not the B area, because I still say that there's a risk, is because the risk to reward is so much higher, right? So the expectancy of profit in a trade is not only about, oh, how much money can I make? Because if you can make 10%, but you lose 100% of the times, that is not a profitable decision, right? So it's important to understand that this is a very good area, because even though you might miss time the low and you get tagged out once and you enter again, that time that you enter again is going to completely outweigh all of the other times in which you are going to take a loss. That's why this is the A area. It's the highest risk to reward. Then the B area, second third of the range. Good risk to reward, but there's some manipulation risk, but a good stop loss, usually below the low or the high, solves that. Great probability continuation entries happen in this area. And C is the third of the range. Is a bad risk to reward, is a high risk of being manipulated, and there you are late into the move, right? So for example, if we just think about simple maths, on the A, yes, you might not have the biggest strike rate, but you are going to have the biggest risk to reward. Therefore, your profit expectancy is going to be way higher. On the B area, you're going to have a higher strike rate, but a little bit of a low risk to reward. That's why the A area is even better. And then last but not least, we have the C, where you have huge stops, no reward, and there's still a risk that you get manipulated. And that's why that's a bad area to trade from, right? So it's always important that when you know where the low is and where your target is, you draw a fib and you want to execute in the first 66% of that range, which if we go to the power of 3, which again, notice how all of these things interlink. That's why I absolutely love trading. And that's why the students that come into Funded Trading Blueprint, they're like, oh my God, I can't believe I've never seen it this way, because it's like the pieces of the puzzle. It just makes trading so amazing, right? So we have the move to the downside. Now you think that this is the low. You draw the fib, right? And notice how right here, highest risk to reward, good risk to reward, and then up here, you don't have a range anymore. So then you get manipulated, and there you go. You don't take a win, right? So that's why I absolutely love talking about high value areas. This is a very, very important concept for you to master. Now, SMT or SMT divergence, some people call it the smart money technique. So what is it about? The SMT divergence is a discrepancy in price delivery between two assets that should correlate. Many traders get this wrong because they don't understand what it means or where to look for it. But first, what does it look like? So this is what an SMT divergence is. We have pair A and pair B. These are pairs that should correlate. So for example, we can say that this is NASDAQ and we can say that this is the S&P. Right? The market should move very, very similarly between NASDAQ and the S&P. It's the US stock market. You expect them to move in tandem. But every time that you see an SMT divergence, which means, for example, the NASDAQ forming a higher high while the S&P 500 is not forming a higher high, this tells you a lot about price. This means, as you can see in the screenshot, pair A formed a higher high. Let's even do it like this. Pair A formed a higher high and pair B formed a lower high in the same period of time. For many traders, this means that pair B is generating liquidity to run the highs, but that could be further from the truth. So a lot of traders think that, oh my God, now this has highs, so this is going to move to the upside, and this one is not, when it's the exact opposite. That's why I want to make this video. So many people explain liquidity concepts so wrong because they don't understand that there's more to the market than just liquidity. There's more to the market than just market structure or just daily bias or just fair value gaps and just order blocks. You need to piece these things together, right? So that's why here in this video where I'm breaking this all down, more than an hour long, we are making sure that you learn the right way so you can get funded in 2025. Right? If you want this resource, again, the link is going to be in the description. I've given this to my students and they were absolutely amazed at how much this has changed their trading. So the S&T shows us that pair B is the heaviest pair out of the two, meaning that if the bias is bearish, pair B will drop further than pair A. And if the bias is bullish, pair A will rise higher than pair B. So a lot of people, what they do, they look at SMT and they're like, oh, this is what it means. Not understanding that SMTs have to be paired with bias and they have to be paired with high value areas. So many traders trade the wrong pair because they believe one or the other will catch up, when this is very rarely the case. These are small clues that price gives us that give us an incredible edge. In other words, if the bias is bearish, pair A is still looking for liquidity, therefore creating higher highs. So it's creating higher highs, while pair B has already gathered enough orders, so it's ready to move to the downside, therefore not creating the higher high. So pair B is going to move way more bearish. So if the daily bias is bearish, the pair you want to execute on is this one. And that's why yesterday I made a $3,000 trade, $3,400 trade, because I looked at this exact thing. You know what? Let me show it to you right now. So these are both the same time frame and over the same time period, right? So you can see this very big candle to the upside, very big candle to the upside. These happened at the exact same time. This was CPI. Then after the market opened, notice how this NQ continues forming higher highs while Nasdaq is failing. So Nasdaq is showing you, I am bearish. I want to move to the downside, right? So a lot of traders, while they think, oh, Nasdaq has to move towards the lows, I'm thinking, well, S&P is going to move way further. That's why I executed on the short on the S&P 500 and I made $3,500 just on this trade, $3,400. It was a 1 to 6. Because of partials, it was a 1 to 5 hour. So with that being said, you can see how the SMT divergence applies beautifully because we have key area because the market reached a very high value area, and then we have the difference in price delivery. You can see that this exact same thing happening. So that's why I really love the SMT divergence, but you need to learn how to use it the right way. So why do traders get it wrong? SMT divergence are a very strong concept that have in your arsenal, but many traders overemphasize it, therefore believing that an SMT divergence in the top of the range means anything, while market structure is still heavily favored in one direction. SMT divergences will be the confluence in our entry, but individually they don't mean anything. We look for SMT divergences for daily pair selection and pair selection at the time of entry. So we can see this right here. This is for daily selection. So who do you think raced toward this high? Right? If they're racing towards this high, what pair do you think will reach it first? Some of you might say, oh, it's Nasdaq because it's going to catch up to the S&P 500. When in reality, you can already see the difference in price delivery. This bearish candle is way more bearish than this one. This candle was bearish while this candle was bullish. So you can see how this is always forming lower lows. Here, we already formed the higher low. Yes, we swept the lows, but this is 3 lows in a row, while this one is just 2. So you can see that not only did the S&P reach it one time, it actually reached it 2 times, while Nasdaq didn't even reach it once. So that's why pair selection on the daily is so important. And for example, and with my students, I was telling them this for a long time, which is if your bias is bullish, you want to long S&P 500. If your bias is bearish, you want to short the Nasdaq. Basically, that's what I was saying in all of my forecasts for the market, which we do 1 a day. And that is very, very helpful for people's journey. It's basically daily guidance. I send them a video every single day of what my forecast of the market is. So you can see it right here. Now, this is the next one for entries. So if we have a race to the lows, if our bias is bearish, What pair do you think is going to move more to the downside? Is it NASDAQ or is it the S&P 500? Again, notice the difference in price delivery, right? We already have the market failing to create a high, while here the market not only creates a high, but it closes above the high and it goes even higher, while NASDAQ is failing to move the high. So notice the difference in reaction. While NASDAQ goes to all of these lows, the S&P 500 barely sweeps these ones. So can you see the big difference in price delivery? And that's why the SMT divergence is such a powerful concept. Now, last but not least, and this is the best one because it puts everything together and I absolutely love it. And this is what our entries are going to be based on: market maker models. Market maker model stands... MXM stands for market maker models without even knowing I was already saying the name. So there are market maker buy models and market maker sell models. And this is the first time that we can put everything we are learning together. So we have what? We have higher time frame PD arrays. We have market structure. We have bearish market structure turning into bullish market structure. We have market structure in lower time frame and higher time frame aligning. We have multiple things happening. But this is what market maker models are. It's simply a depiction of how price delivers. And by understanding how price delivers, we can understand how we want to execute on price. So let's say that our bias is bullish. So what you are going to look for is a market maker buy model. You're going to wait for the market to move lower towards a higher time frame PD array, which is going to be the sell side of the curve. Yes, you can take the shorts. Again, you are trading internal market structure, right? We've talked about market structure. And then once we hit the higher time frame PD array, we have the market shift. But because you are pairing the higher time frame PD array with the market shift, with the market structure, with the bias, this is going to be high probability entries because now we are on the buy side of the curve and this is where we are going to be taking our entries. Spoiler alert. Then on the bearish, it's the same thing. Let's imagine that we have a bearish push. What do you want? You want a market maker sell model. What is this? By the way, what is this? This is, notice, if this is on one day, notice how the daily candle is going to look, right? Can you see how this is an extremely bearish candle? So what you want is, okay, the market moved bearish. I have a bearish bias, but I need people to get manipulated into thinking that the market is bullish, when in reality, this is just the first magnet of price for then the market to move in our specific desired direction. So we have the market maker buy model, market maker sell model, which again is just a move towards a higher time frame PD array, followed by the market shift that allows us to then enter in line with the bias. So what do we apply? With market maker models, we apply everything we have learned so far: market structure, liquidity, high value areas, power of three, SMT, just everything. It's the basis on how we trade. You won't be able to unsee that this is how price delivers. So here are some examples. We have a bullish bias. The market moves to the downside, ranges, sweeps, moves higher, market shift, order block, moves to the upside, right? Very beautiful. This is where we move to. This fair value gap. That is the magnet of price. That is why we had the bullish bias. Right here, same thing. Market moves higher, range, generating liquidity. Notice this is bullish market structure, right? This is all internal range liquidity. And then the market sweeps the previous high, sweeps these highs too. Market shift, moves to the downside, right? So what do we have? Move up, range, move up, market shift, move lower, right? Exactly a market maker sell model. Same thing here. Market moves up, range, sweep, moves lower, boom, and then we move to the downside. That's a market maker sell model. Same thing here. We have the move to the upside, higher time frame PD array. The market starts to move lower, taps it, range, manipulation, right? Power of three, everything. Then we have this move to the upside, market shift, entry, and then very clean move to the upside to the external range liquidity. And all of this is just internal range liquidity, super easy to target. And by the way, notice, I didn't even notice this until now. Notice this very nice where the market, let me see if I can do this. So this is the high. Notice how we come to the extreme, we react one last time before moving higher. Again, that is why we take profits at the extreme. Now, another one, way more zoomed in, market maker sell model, where we have move up, move up, move up, market shift, boom, and then we move to the downside. And last but not least, we have a market maker sell model, extremely, extremely aggressive manipulation, and then we move to the upside, and you can see we move still to the upside. So that is what we are going to call the market maker models. And now you might say, well, but how do we apply this? Don't worry. We are basically going to be putting everything together. So now you have learned so many things about price, so many things. You understand market structure right now. That allows you to understand direction. Direction is allowing you to understand daily bias. Your knowledge on daily bias becomes even stronger once you understand liquidity. Power of 3 is going to help you understand how price delivers. Fair value gaps and order blocks are the foundation of where the market is going to move to. It's the bullish and the bearish PDRAs. It's also where we are going to have our entries. But none of this matters if we are not at a high value area. So we understand high value areas. We understand what an SMT is. We understand what the market maker models are. And right now we are going to talk about time and price theory. But before that, if you guys want to check this resource out fully for free, it's going to be linked in the description. Don't forget, if you want to get this fully for free, the link is going to be in the description. And obviously, if you want daily guidance, the link is also going to be in the description. Now, let's talk about time. Time is going to be divided into sessions, and it's going to be divided into time-based liquidity. So sessions, let me talk about true session times. Trade what is on the charts. One of the things that I don't like about everyone that is out there, they're like, no, this is the true daily open. When in reality, that is just complicating life for you. Because if I tell you right now, the true daily open is only 5 hours after the daily candle opens up on TradingView, you're gonna be like, what? So you're telling me that what I'm seeing on the chart is not the real thing? Obviously it is. Else it would not work the way it works, right? So trade what is on the charts. The day open, it's at 6 p.m. Eastern Standard Time. And the daily close, is at 5 p.m. Eastern Standard Time. This is because we are going to use this on indices, on NASDAQ and on the S&P 500. And then London session is going to be from 3 a.m. into 6 a.m. And New York session, because is when the stock market opens, is going to be divided into 2 sessions. You have the AM session, which is from 9 a.m. into 11 a.m. But obviously 9:30 a.m., that's when the market opens. And then you have the PM session that is from 12 p.m. All of these are in Eastern Standard Time to 2 p.m., right? So this is going to give us time-based liquidity. Why? Well, again, we can pair all of this together. When did I say that the power of 3 applies? It applies also in sessions. The reason why is because the power of 3 is about who is making money and who is losing money, right? So if I'm giving you a session and I tell you that London session starts from 3 a.m. to 6 a.m. Eastern Standard Time, you can now look at the charts and be like, okay, London session opened up at 3 a.m. Eastern Standard Time. That means, let me draw a line on London session. That means that every single person that longed, for example, if the market just moved to the upside, every single person that longed is making money. But my bias is bearish. So that is what we call time-based liquidity. And then we also have the question of time-based liquidity of where the highs and the lows are. Because liquidity, again, it's resting orders. And it's also based on who is making and who is losing money. So let's say that we have a range, right? So London session, let's say London session moves up a little bit, right? This is the low of London session. And then New York opens and the market is bullish, right? New York opens and the market is bullish. Yet the market instantly moves to the downside. And you're like, that's weird because the market is supposed to be bullish. What is the market doing? This is all just manipulation for the market to move to the upside. Because now we've targeted all of the London lows. So everyone that longed during London and put their stops below here has now been taken out, and now the market can freely move to the upside with no London traders on, probably even people just shorting, right? So that's why we are using time-based liquidity a lot. Time-based liquidity looks the same as structural-based liquidity, but it adds in the time factor. There are session highs and session lows from all of the sessions from before. So you have Asia and you have London in our case. You have daily highs and daily lows that are marked by the daily candle, because again, if we are bearish and everyone that shorted yesterday is guaranteed to be losing money, you have an incredible edge of waiting for all of those to lose money and them to get liquidated, the market shifting in your direction. And what is that going to be? That is going to be the market maker sell model, right? Imagine that this is daily high, the previous day high, right? So previous day high. And the market starts to move higher. All of these people now are losing money, right? They are getting liquidated. And then once the market shifts, you're like, there you go. That's when I'm going to execute, right? So that is personally why I love time-based liquidity too. So we're going to have session highs and session lows, daily highs and daily lows, weekly highs and weekly lows. So this is a lot to digest. This is a lot of information for you to watch. And again, I hope you have been able to learn a lot of these concepts. If you have to watch this video again, don't worry, the video is going to be here for a long time. You can get this resource fully for free, but now we've talked about everything. We've talked about market structure, daily bias, liquidity, power of three, fair value gaps, order blocks, high value areas, SMT, market maker models, time-based liquidity. We've talked about many things. And all of these, they pair together. And they're going to give us an incredible edge if you understand all of these things. That's why downloading this resource and understanding, okay, what do I master out of all of these things is going to be so crucial. And if you have any questions, you just come back to this video, ask me questions in the comments, whatever it is. I will try to reply to as many as I can. But it's important that now we piece all of this together, because don't forget, the goal is to get funded in 2025. I am giving you all of the tools you need to understand price, because by understanding price, you will be able to get funded in 2025. You will. Okay, so let's now go into our entry model. Our entry model is going to be on NASDAQ in the S&P 500, which is ES. The entry checklist: always trade in line with the daily bias. No clear daily bias equals no trade. If you don't know where tomorrow is going to go, you just don't trade. That is, for example, happening today on currencies. I'm even recording this video. This is taking me hours to record because I know I don't have to trade on the FX market because I don't have a clear bias. So always trade in line with the daily bias. You wait for the 9:30 a.m. open because, again, you want to trade the easiest sort of price action. And personally, I believe that the easiest price action comes after the market open. You wait for manipulation, which is going to be the power of three and the market maker models. No manipulation is needed when the draw on liquidity is extremely obvious and we have manipulated pre-market open. So, and the reason I say this is because let's say that the market is already all the way up here, right? So we are close to this on the daily, but there's still room for you to trade, right? So don't think about the high value areas also on the daily as much. And it's obvious that the market is going to reach this high today because it's so close to it. There's news catalyst, there's everything. So let's say that over London session, the market moves a little bit bearish and then the market only moves bullish and it already tapped the higher time frame PD array. You don't want to wait for as much manipulation. You don't want to be black and white with this one. The reason why is because when the market is clear on where it wants to go, it will go there quick. It will go there very quick. And your number one goal is to take advantage of that move. So no manipulation is needed when the draw on liquidity is extremely obvious and when we have manipulated pre-market open. Then you wait for a tap of a higher time frame PD array or a tap of a 15-minute PD array, so a fair value gap or an order block on the 15-minute in line with your bias, or a sweep of session liquidity, in this case, London. Higher probability if it's a 1 hour or 4 hour PD array. 15-minute PD arrays can be used when the daily bias is clear. Once again, same exact example that if the market just manipulates a little bit and it taps a 15-minute PD array and starts moving higher, then you just want to execute on that market maker model there, because else you will always be sitting in the sidelines when the market is quick. And when the market is quick, you have high risks to rewards and you have barely no drawdown. That's why I love quick markets too. So tap of a higher time frame PD array, tap of a 15-minute PD array, and sweep of session liquidity. Then you want to wait for the market shift. So notice exactly what we are doing is the market maker model. If we're bullish, again, you want to wait for a little bit of a move lower. That's manipulation. You want to wait for the market shift and you want to enter, right? So we're waiting for everything we've talked about before. So in terms of market shift, there's 3 possibilities. 1, the conservative. You wait for a 5-minute market structure shift, and I'll show you some examples afterwards. You wait for a 5-minute market shift. That is the conservative. You're going to have a good risk reward. You're going to have a good strike rate. You have a less conservative, which is a 1-minute market structure shift. This is very good when you already know where you are looking for these trades, right? When you are very, very clear on what the market structure is, internal, external, higher time frame PD arrays, you understand daily bias, you can wait just for 1-minute market structure shifts. That's personally what I like to do. And if I'm incredibly biased in one specific direction and I expect the market to reach it very, very soon, then I go even more aggressive. I wait for the 1-minute fair value gap to invert. The more aggressive you are, the higher the risk reward you have, but also the lower the strike rate. Because one of the things that is important is understanding what I call the trading trifecta. This is personally something that I came up with. I don't know if anyone has talked about this before. Personally, this is something that I came up with, which is you can pick 2 out of the 3. You have strike rate, trade frequency, and risk reward. Let's say we maintain the trade frequency, that everything that we're playing with is strike rate and risk to reward. When I say that you are going to be more aggressive, what is happening? You are increasing your risk to reward, but because of that, you are decreasing your strike rate, because if you're being more aggressive, there are many times where you are going to be faked out. While someone that is less aggressive, they might reduce their risk reward a little bit, but they are increasing their strike rate. So that's just one thing to keep in mind. The level of conservative or aggressive that you are depends on how clear you are on your bias and levels you are trading for. That's basically how I approach it. Then SMT at the high value area, bearish bias, you choose the pair that has made the lower high at the high value area, or with a bullish bias, you choose the pair that made the higher low at the high value area. So again, this is optional. It's just an added confluence. So basically, if the market is bullish, you want to execute on the pair that did this between NASDAQ and ES. And if you are bearish, then you want to execute on the market that did this, on the pair that did this. So that is basically the SMT, and that is just an added confluence. And your entry is at the 1-minute fair value gap. A minimum of a 1 to 2 risk to reward, TP at the last internal low at the extreme. We've talked about this before. So your take profit is going to be at the extreme. That's the only reason, by the way, that yesterday I took the win. Again, let's go back to my entry yesterday. So notice how the only reason yesterday I took my win was because I targeted the extreme right here. So let's do this. Notice I targeted the extreme, and that's the only reason as to why I took this win. Else, I would have been super, super close to a break even. How crazy is that? Right? So we are going to be targeting the extreme. We are not going to be targeting the external market structure or external liquidity, whatever you prefer to call that. So 1-minute entry on the fair value gap, minimum of 1 to 2, TP at the last internal low, and stop loss above the high plus 10%. Basically, this is just to add a buffer at the high for spreads or even for some sort of tiny manipulation that might happen. So if you have a 20 handle stop or a $20 stop, you add 10% on top, you do 22% is going to be, or 22 handles is going to be your stop loss. So again, in terms of market maker models, you can see it right here. With a bullish bias, you would want the market to come to a higher time frame PD array. First market shift, second market shift, both of those are entries. And then you can also enter, by the way, on the third market shift. Don't worry, as long as you are in the A and B area, you can execute on the fair value gaps and order blocks that are in line with your bias. Then on the sell side, we have this move, higher time frame PD array tapped, market moves lower, taps, that's your first entry, that's your second entry, market moves lower, this is your third entry, so on and so forth. So that is very, very good for us to understand how market maker models are going to apply basically perfectly to our entries. So our entry model puts everything we have learned together. We have market maker models which need to be in line with the daily bias, which go from bearish to bullish market shift on a lower time frame. So for example, in this case, what is the higher time frame? It is bullish. The market structure is bullish. Once it moves lower, the lower time frame is internally bearish. So externally we're bullish, internally we are bearish, but once we even internally turn bullish, then all of a sudden you have a high probability entry. That's why this is where our entry is. Our entries are at the order block or the fair value gap, SMT for extra confirmation. So here are some examples of our entries. So we have the sweep of the previous highs, sweep of the highs. We have the market shift, so bearish daily bias, tap of a 1 hour order block, which is this level right here, sweep of a high, 1 minute market shift, entry on the fair value gap right there. Boom, a little bit of drawdown, and then we move to the downside. I think this was 10% drawdown. And then the next one, we have also the high that gets swept. The market moves to the downside. Notice this bullish fair value gap gets inverted by this candle. Then it taps and it moves to the downside, right? So you can see how this is our entry. Bearish daily bias, sweep of a 1 hour high, sweep of session high. So this is London session, right? Sweep of session high, manipulation at market open, 1 minute fair value gap inverted, entry at the inverted fair value gap, right? So that is the second example. Third example, we have bearish daily bias, mitigation of 4 hour order block, SMT at the highs. So right here, this is SMT. On ES, we had the higher high. 1 minute market structure shift, entry at the fair value gap. So we have SMT, market shift right here, fair value gap, entry, and then we got the move lower. We got a spike, and then the market moves to the downside beautifully. And then last one, we have a buy where we have the market moving lower. This is session-based liquidity. Market moves higher, moves to the lows, sweeps, opens, moves up. So everyone that is longing is making money. Everyone that is longing now is losing because of this manipulation. And then we have this fair value gap that gets inverted and the market taps it and moves to the upside. So if you want to enter in the inverted fair value gap, you can. If you want to enter in the market shift, you can. There was also an entry. And then as the market moves forward, you can still enter here and then target the highs. So bullish daily bias, mitigation of 15-minute order block, sweep of session lows, market open manipulation, 5-minute market structure shift. Yes, by the way, this was a 5-minute chart, so you don't need to only do it on the 1 minute. And then entry at the fair value gap, inverted fair value gap, or order block. Right? So there's many ways to enter in this trade. There's many ways for you to profit from what I've been giving you right here. So let's go over the entry model again. So we have always in line with the daily bias, wait for the 9:30 a.m. open, wait for manipulation, so the power of 3 and the market maker model, tap of a higher time frame PD array, again, this market maker model, wait for the market shift. That's a market maker model. Decide how aggressive or how conservative you want to be. This can be based on the higher time frame and how clear the direction is. Either wait or don't wait for SMT divergence if you only want to trade one pair. So for example, I prefer to trade NASDAQ. So if they're very similar, I just end up trading NASDAQ, right? Even if there's a tiny SMT. And then the 1 minute entry on the fair value gap. Let's even put inverted fair value gap and order block, right? So minimum 1 to 2, TP at the last internal low at the extreme, stop loss above the high. Now, for trade management, your stop loss management depends on how conservative you want to be. If you want to be conservative, if you want to be less conservative. We're going to call it the 4 PD array rule or 3 PD array rules. That means that stop loss is behind 4 PD arrays, fair value gaps, and order blocks, or behind 3 PD arrays, fair value gaps, and order blocks, right? So basically, as the market is moving, so let's say that the market is all the way down here. So stop loss placement, you already know, above the high, plus 10%. Then, this is for managing the positions. Let's say the market is all the way down here, right? You don't know, okay, where am I going to manage this trade? Just think about this. 1 PD array, 2 PD arrays, 3 PD arrays, right? Your stop is going to go above this fair value gap right here. This is what your stop loss is going to be. Down here, we have 1 PD array, 2 PD arrays, 3 PD arrays. Your stop loss is going to be up here, right? So basically, you always count 3 or 4 depending on how conservative you want to be. And obviously, this is as the market is moving towards your target, right? So that is basically just trade management. As the market is moving, you want to manage your stop so you are able that even if the market reverses, you can still make money. Now, risk management. The simple guidelines for risk management are going to be don't risk more than 1%, 2 losses in a day max, and 2 wins in a day max. 1 is likely better, right? And if you need any help sticking to these simple guidelines, Trade Blocker is going to help, right? With Trade Blocker, you can click one button and all of your trading platforms will be blocked. You will have to wait until the next day so you are able to trade, right? So the simple guidelines is don't risk more than 1%, 2 losses in a day max. So if you take 2 losses in a day, just use Trade Blocker, block yourself out of the trading apps. Or 2 wins in a day max, 1 is likely better. Because again, if we have a 1 to 2 risk to reward, let's say you take 2 losses and on the next day you take 1 win, it's over a 1 to 2, so technically you are in profit. So that's why the 1 is likely better, 1 is likely better. Now, because the goal here is to get funded in 2025, I believe it is extremely, extremely important to talk about risk management for prop firms because now you are a profitable trader, right? You are now a profitable trader. You have made it this far. You've watched the strategy. You have an entry checklist. Now it's about being able to apply it on the prop firms. Now, congratulations if you have made it this far. Again, if you want this resource, it's going to be linked in the description. And congratulations that you've made this far. A lot of people, the reason why they fail is because they can't even watch a hour-long video that is still telling you everything I would have loved to know when I was a beginner trader. So because it's the full guide on getting funded, let's talk about the risk management for prop firms. So on the challenges, if you never got funded or you never got a payout or you already got funded and payouts, so those are going to be 2 different risk managements. And I'm going to give you a formula for you to understand what you want to do. So it's dependent on time. If you want to get funded faster or you are taking your time, just understand if you want to get funded faster, you are going to be losing a few more challenges. That's why this ratio changes, or you are taking your time. So if you want to get funded faster, go for a challenge 1/4 of the size that you can afford. Or if you're taking your time, go for a challenge half of the size that you can afford, which means if you can afford the 100K account, go for a 50K account. Or if you want to get funded fast, which means you are going to risk more, go for a challenge 1/4. That means if you can afford the 100K account, start with a 25K account because again, you are going to lose a few more challenges if you do this. So if you want to get funded faster, the risk that you are going to use is going to be max drawdown divided by the number of trades per week. I have here an example, which is the My Funded Futures Expert account, which is the 50K account with $2,000 worth of drawdown and $4,000 worth of profit target. Again, different companies are going to have different rules. That's why I'm giving you an equation and not an exact number, basically. So max drawdown is $2,000 divided by the number of trades per week. That is going to be around 5. So that gives you a $400 risk per trade, right? And this is going to give you the position sizing. And if you are taking your time, if you're taking your time with the challenges, then you are going to risk max drawdown divided by 1.5 divided by the number of trades per week. So in this case, it would be 2 divided by 1.5 divided by 5, which would be around $260. It simply allows you to have a little bit of more of a losing streak. That's why you are more likely to pass in the I am taking my time, right? But if you've already got funded and payouts and you want to get funded faster, go for a challenge half of the size that you can afford. The risk is going to be max drawdown divided by 0.8 divided by the number of trades that you take per week. And if you're taking your time while already being funded and while already getting payouts, go for a challenge half of the size you can afford, and the risk is going to be max drawdown divided by the number of trades per week. So you can see that is similar to the previous one. But in this case, people that never got funded and want to get funded faster, that's the amount that they would risk, while you are taking your time when you already got funded and payouts. That's the risk that you are using. So this is very, very carefully thought about, because I don't want you to lose a lot of accounts. I don't want you to blow through $50,000 worth of challenges just in order to be able to get funded, right? So understand where you are at in this diagram, and then you can understand how much you should be risking. And this is for futures prop firms specifically, right? So as you can see, we've gone through everything. We've gone through the strategy. We've gone through the entry. We've gone through the trade management, the risk management, simple guidelines. We've gone through the risk management for challenges. Now it's all about putting this into practice. And if you want to get this board all for free, the link is going to be in the description. And do keep in mind that this is something that I'm not just saying. I've gotten hundreds of traders funded. Every single week, I get a message from a different trader telling me that the YouTube videos or that the course has extremely help them. So that's why I've made this video that is hours long, just in order to show you how to get funded fully for free, how to get funded in 2025. And you can see that through the certificates that I have from Bryson, Sander, Nuno, Miguel, Gabriel, Trade Ciento, William, and so many more that I did not put here. We have traders that for almost 10 years, they're looking at the market in a random fashion, but after joining Funded Trading Blueprint, the community, they can see how the market moves and how professional it really performs. I am learning the full strategy to approach the market in a realistic expectations out of it. I am confident that I'm learning the correct way. Or JDFX that joined in August of 2024, got funded in November of 2024, and they already got a payout. Funded Trading Blueprint is not only about getting funded, it's about getting payouts. We can see once again, Locke, I made it. A huge thanks to Kimmel and this amazing community. You make me all feel less alone in this trading journey. So again, King Locke that got a funded certificate, Octavian, another certificate, Andrew that not only passed the FTMO challenge, but got a profit split. Albion that joined and he did not know how to trade, and now he's not only a funded trader, but already got payouts. So all of this is inside of Funded Trading Blueprint. I'm going to hold your hand. I'm going to give you daily analysis. So if you want to get funded in 2025, yes, you can do it with everything that I've given here, and I seriously recommend you doing that. And if you want to join a community full of funded traders and like-minded traders, then make sure to join us at Funded Trading Blueprint. So don't forget to subscribe. I'm going to give you way more guides on how to master trading, on how I've made hundreds of thousands of dollars from these markets, so you can do it too. Hope you enjoyed this video. Click right here to watch the full guide on getting funded this year. And if you're looking for a reputable firm to get funded with, then Funded Next is the way to go. Click right here and use code Kimmel for 120% refund. And if you're struggling with overtrading, you already know Trade Blocker is the way to go.